Today's topic, I'm going to discuss 7702 plans and try to fully explain it from the good, the bad, the ugly. And reason being is we've been getting a bunch of calls into our office from individuals that have been watching social media on the different infinite banking concepts. And some of it is accurate, some of it is not accurate. And, nothing's ever going to be a magic pill regarding how an account grows and how to be able to utilize that account. But when you structure these plans, and all it really is just an overfunded cash value life insurance policy, and you're utilizing the cash value within it to grow the monies within your account tax-free, be able to pull your monies out tax-free, and then when you pass away, leave a legacy or leave some sort of death benefit to your loved ones on a tax-free manner. So those components sound great, but in reality, if you're getting set up with this plan in the wrong way or for the wrong reasons, it could be a complete disaster. So a complete disastrous situation is placing thousands and thousands of dollars into these sorts of accounts and into the wrong accounts with the wrong carriers that maybe have very limited growth potential on there. They might have long surrender schedules, meaning that dollars that you're looking to pull from within the first couple of years, realizing that if you try to take out monies, you're getting a ding with these surrender penalties within the first 10 to 15 years. And then most importantly, insurance agents could hoard a lot of dollars, a lot of expenses within these sorts of accounts if they're structuring it the wrong way. And that's really the concept of this, is to properly structure your plan and then see if those benefits match up to what your goal is, what your ideal retirement goal is. So you can use these types of accounts as an efficient puzzle or a piece for your ultimate puzzle, for your retirement puzzle. But once again, you just have to be careful on it. So what this video is going to try to accomplish is showing you when individuals set them up the correct way versus when they could be setting up the wrong way, different traps to avoid, and then where to look for some of the best carriers. At any point in time, if you have specific questions or you are interested in getting set up with one of these plans or just want some valid feedback, if it could be mathematically efficient for you and for your situation, or if you should run from the hills because you don't have the time horizon, or maybe you're not hoarding in the necessary amount of dollars that you have to in order for this to be a successful route. So, I hope you found value in this video, and just feel free to take down notes. And once again, feel free to give our 1-800 number a call at any point in time and just reference this video so we could set you up with the correct advisor that's knowledgeable with the subject matter. So the most generic 30,000-foot view explanation that I could have for a 7702 plan is an individual is trying to place monies aside, and they could do this on a monthly basis. They could utilize large lump sum dollars. If, let's say, they have cash accounts that are just basically sitting there, not gaining any sort of interest, and they want this money working for them, but they're risk averse, they don't like to leverage the market, they don't want to see downward market losses really impact what their account balances are. That's where, from a taxation standpoint, this can be a beautiful scenario. So what ultimately happens is an individual is looking to place contributions into this sort of product. We call it account, call it a product. And ultimately, whenever somebody's going and they're leveraging permanent life insurance, what they're doing is they're placing a premium, and that's going into a policy, and that policy is going to have a combination of cost of insurance and a little savings component known as cash value that occurs with any premium dollar that's being placed into this plan. The cost of insurance is determined by the death benefit that this person gets set up in. So simply put, if somebody places $1,000 a month and they had a death benefit of $500,000, for just argument's sake, for just a simplistic example, maybe $900 is going towards that cost of insurance, and you have $100 that's being left over into the cash value bucket. Versus if you had another plan that, let's say, had $100,000 of a death benefit, and this individual put $1,000 per month into it, maybe $800 is going into the cash value, and only $200 is going to the cost of insurance. Now, why is there a difference there? There's a difference because the risk is different. The net amount at risk to the insurance company is different from somebody that has $500,000 of death benefit coverage versus $100,000 of death benefit coverage. That's a large difference. That's $400,000. If this person pays one premium payment, then they get hit by a bus. This insurance company is now off the books of $500,000 that they have to pay tax-free to this individual's beneficiaries. So that was obviously a large loss. So a way on how the insurance company, they understand actuarial data and the law of large numbers. As new monies are coming in, older policies, those individuals are dying off. So they're able to take those dollars, invest it into their general accounts, and understanding the actuarial data, how long individuals live, they're able to churn some sort of profit. But it's all about, basically the underwriting on how healthy somebody is and then the death benefit coverage. And that's what's going to determine the net amount of risk. So the first little trick with these policies, when it says properly structured, if somebody's trying to grow their cash value, this little savings component, I just apologize for my chicken scratch on the screen, but this is kind of conceptually the best way that I could explain it. If somebody's trying to increase the amount of cash value, does it make more sense to increase the death benefit, which is going to have more costs, or does it make more sense to decrease the death benefit and therefore have less costs, even though the premium payment was exactly the same? The obvious answer is the latter of those two scenarios, the one with obviously the smaller death benefit, because it's going to result in less net amount at risk. So once again, if I re-explain that in a cleaner scenario, $1,000 goes in, cost of insurance and other expenses are hoarded in there. You have less cash value if you have a $500,000 death benefit plan. By reducing the death benefit, let's say in this example, we drop it down to $200,000, the same $1,000, you have less cost of insurance and other expenses and more dollars going to the cash value. Because what happened was we focused in on net amount at risk. We want to really maximize that cash value accumulation. We would try to drop that death benefit down even further. So be mindful of this, because there has to be a correlation, it's known as the cash value corridor. And there has to be a correlation between your cash value growth and your death benefit. And the reason why 7702 plan, or why it's called 7702, is you have to stay in compliance with Internal Revenue Code 7702. By making sure your death benefit is at least at some sort of minimum, that it's not going to mech the policy, known as a modified endowment contract, then that allows your cash value to remain in that tax favorable status, the tax-free growth, be able to pull your monies out tax-free and leave a tax-free death benefit. That's really the trick with these sorts of properly structured 7702 plans when they're done the correct way. You want to make sure the death benefit is as low as possible so that the dollars that you're placing into this account, whether it's systematically placing in there for 10, 20, 30 years, or you're trying to take large lump sums. Let's say somebody has $500,000 bucket and they want to splice out $100,000 per year for the next 5 years of premium payments. It all goes off of that same generic concept of you placing dollars in there, having the smallest amount of death benefit so that your cash value could accumulate the highest possible way. And there's different product lines on leveraging this sort of strategy, but that doesn't mean that all these product lines are good. Majority of them are complete, excuse my language, dog shit. What I mean by that is, if you think of this little funnel bucket, this is what I just explained, what we did on the other screen. If you reduce the net amount at risk and you reduce the cost of insurance and other expenses, it's going to allow you to net more dollars into this type of bucket. Think of it like the contribution going into your account. Now, this other side on how the cash value grows is by the rate of return. And this is determined by the type of policy that you're getting set up. If someone's interested in a whole life insurance policy, this sort of rate of return is going to be more fixed. The way on how the life insurance carriers pay this out into the cash value is, think of it like a type of fixed account, but it's in the form of a dividend. It's basically like a return of premium that's going back into your plan. If, let's say you go with just a true universal life, and this was very popular in the 1980s, this would be tied to interest rates. Well, unfortunately, since that point, interest rates have dropped down to all-time lows. Obviously, they've been increasing a little bit in really this past year. But if they drop back down, this is going to be, a horrible type of policy to use, just like those individuals that set them up expecting in the 1980s, expecting these large rates of return of 20, 22%, and then in reality, they're only getting 1-2% on their monies on this sort of cash value. You have VULs, which is variable universal life, which they're leveraging sub-accounts. They give them like mutual funds. So this rate of return could either be positive or it could be negative. And then the last one, which we typically like to leverage, is known as IULs, index universal life, showing that this rate of return could be positive or it could receive 0% as a floor. So it grows whenever the market indexes that are linked to it increase, gains 0% whenever those indexes go down. And the reason why I typically like to give the nod more towards the index universal life versus the whole life is because of the flexibility. The whole life, you have a lot of things that are fixed. A lot of the terminology, depending upon the carrier, is fixed. And then also that rate of return is fixed. With the IULs, you have more variability in there and you have a higher potential rate of return, but with that downside protection of a 0% growth rate if the market is not producing favorably. So when we're looking at a properly structured 7702 plan and we're looking at the benefits of it, once again, that could sound, fantastic. You have something that could ultimately grow tax-free. You could pull your monies out tax-free. And then if you were to pass away prematurely, you pass away when you're in your retirement stage, you would leave a death benefit tax-free to your beneficiaries. So from a taxation standpoint, it can be an amazing tool or an excellent asset to leverage. Many risk-averse investors also want to try to beat out the pace of inflation. And they don't want to risk their money in the market, but they still want a fighting chance to beat out inflation. And maybe they feel like fixed accounts are not paying a favorable rate of return currently. So that's where it could also be a hedge against inflation if you're looking at it, once again, from the long term. And the most common mistakes are individuals that are trying to utilize this and trying to leverage it from a jack of all trades type product. Oh, I want to place it in there, and then after a couple of years, I'm going to go and borrow against this policy. I'm going to purchase a car, and I'm going to use those monies to do something else and use these monies to do something else. And you're never allowing your plan to fester in there properly. But when used the correct way, you could use it as a tax hedge, as an inflation hedge, protection from downward market losses. So a market loss hedge or a safety hedge, and then also an expense hedge. These things could be very expensive when they're structured the incorrect way, but they can be favorable when you're using the correct product and you're using it with the correct scenario and the correct time horizon. Now, the other aspect is the goal. What's the goal in mind? Essentially, if you're planning for retirement, let's say you're in your 20s, 30s, 40s, whatever that is, and you say, okay, ideally I want to retire when I'm 60 years old, or maybe you want to retire before age 60. And a lot of those traditional accounts won't allow you to do that before 59 and a half. This could be a nice solution there. So you could go and say, okay, maybe I'm placing monies aside into my 401k through work, and I'm getting matching money, but I really want to retire around, 53 years old, 56 years old, whatever that case is. And I want to make sure that those monies that I'm set aside for work and for those different retirement accounts in my IRAs, in my Roth IRA accounts, that those will not be leveraged until I'm at least age 60. You could go and also start placing contributions into these properly structured IUL plans or these cash value 7702 plans and have it grow for that length of time, and then possibly ladder those monies to say, okay, from 55 as an example to 60, I'm going to start collecting income from these cash value plans. And then at age 60, that's where I'm going to turn on my spigots to make sure that I could take it from my other assets. Maybe age 62, you're going to trigger Social Security income earlier. Maybe at age 67, you're going to have an additional laddering strategy of income. So that's where you want to get crystal clear on what your goal is. And this is something that we try to help out individuals on a daily basis off of their retirement planning process. I would say that the most common mistake that's made when individuals trying to create a goal or trying to create some sort of vision for what they see their ideal retirement date is they're trying to utilize 7702 plans in too short of a time frame. They're not placing enough dollars into the plan, and they're expecting it to have this astronomical growth, and that's not how this works. Think of more of the tortoise and the hare situation. You could equate the hare towards investments and fun and exciting and fast and large booms or busts or whatever that is. That's the exciting part of financial planning when you're just trying to grow your accounts on an overwhelming basis. That's not what this is. What this should be structured as is more of the tortoise. Slow, methodical, and safe. You're utilizing this as some sort of safety aspect that's giving you an extra layer, an extra bucket to utilize towards your retirement planning needs. The four most important areas of any sort of retirement plan come down to distribution strategies, investment or growth strategies, estate planning strategies, and also tax planning strategies. From a distribution planning aspect, if you're 10, 20 years out from retirement, you could be more on that slower, methodical pace to say, okay, I have X amount of dollars of discretionary monies left over every month, and I want to make sure that these dollars are at least growing or at least building up some sort of asset that I could utilize when I hit my ideal retirement date, my ideal retirement age. As an example, individuals, when they retire, they're taking money from Social Security income. If they take money from Social Security income, and then they're also receiving money from qualified assets such as 401k or traditional IRA accounts, that could increase your provisional income in Social Security, which could increase the amount of taxation that you're getting from your monthly Social Security check. If you're going and you're adding in this additional asset, and now you're taking monies that are tax-free, that's not going to mess with the or currently as the tax laws stand, it's not going to mess with that provisional income calculation because you're taking it from that 7702 plan. So this means that you could net more dollars from your Social Security aspect when you do hit your retirement date, and let's say in your 60s, and then you could also have this secondary cash flow strategy from a distribution planning side. Where I mentioned the I, investment or growth related strategy, if let's say you just want to place monies aside and you do not want it tailored, or you do not want to become hindered to downward market losses, so maybe you have a portion of your monies that are set up in the market and that's super risky, it's going to ebb and flow with the rate of return could be positive or negative, and you just want something more consistent, that's where this could also be beneficial when we're looking at really the diet process. Distribution planning, which I just mentioned, the investment growth planning side, the estate planning side. This is leaving a tax-free death benefit to your loved ones. Even though death benefit is going to be the least of importance when you're trying to set up a properly structured IUL or properly structured 7702 plan, there is still a death benefit there, and that death benefit is going to be far more favorable than what you would be leaving as an account balance. So this is where that could help. And then from a taxation standpoint, all the different things I mentioned, tax-free growth, tax-free income, tax-free death benefit can encompass, all the four most important areas of any sort of retirement plan, financial plan. So we focus in on the most common mistakes. The number one mistake is leveraging an advisor that is not familiarized with these sorts of plans, and just, maybe having a marketing rep coming to their agency and, pitching, okay, this is the greatness about cash value plans and just go with our company. That should not be the route that you go with. You should go with an advisory group that is very familiarized with it, that they understand, they're able to offer all the types of plans available, and then able to cherry pick which one is best for your specific situation, which one is best for your state, which one is best for your age, for your time horizon, could actually walk you through all the pros, but more importantly, the cons with these things. Because if you shoot enough holes into these things and it's still left standing, it might be something that's favorable for your position. It might be an asset that you might want to utilize and actually place monies towards this sort of account. Or the opposite side, if your time horizon is too small, if let's say the dollar amount is not mathematically appropriate to place those dollars in there because you're not placing a large amount in there, and you're just going to be eaten up with a bunch of different costs, that could obviously be a downside there. The other thing is the company. The company is really a make or break. You might have, in a given state, you might have 110 different offers, different companies that are offering these sorts of products. And maybe out of those, you might only have 2 that could be very good offers. So once again, you have to cherry pick, or this is really what the agencies do, is cherry pick which ones are the best companies for your specific situation. The other aspect is the product line. Does it make sense to go with a whole life versus a universal life versus a variable universal life versus an index universal life? Which one is the most mathematically appropriate for your situation, and really based on your risk tolerance, based on your growth, based on your the taxation benefits that you're trying to utilize, which one would be the best product for your situation? The other thing is the indexes. You might have one company that is giving an index that has a, let's say, 12% cap versus another carrier that is giving you that same index with a 6% cap. So let's just say that it's an S&P 500 is the index with a 12% cap, or an S&P 500 with a 6% cap, and the S&P 500 gains 15% that year. This account is going to give you a rate of return of 12% into that cash value, versus this account is only going to give you 6%. So the next year, if let's say the S&P is down 20%, this one's going to give you 0, this one's going to give you 0. The next year, let's say it's up 10%, this one's going to give you 10, this one's going to give you 6. So in just those 3 years, this one gave you a 22% rate of return versus this one, which only gave you a 12% rate of return because of that cap limit was a lot smaller. You might have some indexes that are uncapped or have different algorithmic components that reduce the amount of volatility and could give you that consistent growth rates within those sorts of accounts. So that's another aspect to be mindful of when choosing the correct carrier, choosing the correct account. How you structure these plans is very important, especially if you might have one scenario where an individual has discretionary monies every month and they just want to place these monies into some sort of asset that's going to give them these different favorable outcomes, versus an individual that maybe has hundreds of thousands of dollars that are just basically sitting at a bank and they're saying, hey, I like the safety of the bank, but I'm not getting a rate of return and I'm really never going to touch these monies for at least the next 10, 15 years. How can I at least leverage these dollars properly to make sure that it's going to correlate to my distribution strategy, my growth-related strategy, my estate planning strategy, my tax planning strategy, and really encompass and really be beneficial for me? So that's where the structuring comes in. You could either use with lump sum dollars or more of those systematic, monthly, annual dollars that you're taking slivers and placing into this, and more of that dollar cost averaging aspect. And really that's where the structuring and the funding come in, work basically hand in hand. You want to make sure that you're utilizing the smallest amount of death benefit so that you could hoard the most amount of dollars into these sorts of accounts. So you're reducing the net amount of risk, reducing the amount of cost of insurance. So you have the most amount of dollars that are going into that cash value component as that cash value is compounding. And then lastly, it's the implementation. Does it make sense to, or when should you implement this sort of plan? By utilizing this asset, you could just let it grow forever, or do you actually want to be calculated with this and say, okay, at age 60, this is when I want to trigger this income stream. I want it to go from age 60 until age 100, till my date of death, or maybe I want to ladder it a proper way. And that's something that we separate ourselves from the pack. And because we understand the inner workings of these IUL plans, of these 7702 plans, we deal with it on a daily basis, on a weekly basis, of individuals that call in that just want to have either that second opinion or they want us to really help them implement these sorts of plans. I'm more off of that mindset that I like to shoot a bunch of holes in it. If it's still left standing, then I'll recommend it. If I shoot a bunch of holes in it and there's still different things that I would personally be on the fence with, that I would never recommend it to a family member, I would never recommend it to a client. So there's many times that I tell somebody, hey, listen, you're absolutely out of your fucking mind to place your money into these sorts of 7702 plans, because you're just going to be paying me a bunch of money in commission as opposed to it actually being mathematically beneficial for you. And that's really the main problem that I have with these things is, the more that this infinite banking concept comes out there, can it be a successful strategy? Yes. But you have to be careful. You have to really dissect the negatives with this and see if that's going to be more of a detriment than an actual benefit. If it's more of a benefit, if there's some mathematical benefit there and this is a nice little sliver that you could add to your overall portfolio and add to your different assets, be an additional bucket to utilize, fantastic. That would be a perfect scenario. But I always recommend be careful whenever you're setting these things up. We have an entire division that focuses in on these plans because of all the smoke and mirrors that these insurance companies like to play with it. But once again, we've seen fantastic situations with this. So I don't mean for this conversation to go dark, but I just wanted you to be very informed from a technical aspect of how these plans work, when individuals can use them the correct way, different things to be mindful of, and really how we could help you out, get set up and really find the correct carrier to implement this plan. If you have specific questions, you're interested in having a conversation, feel free to give our 1-800 number a call. It's 1-800-566-1002. Also, feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos.